Mr. Chairman, Ranking Member Tiberi, distinguished members, I appreciate the opportunity to testify regarding tax issues relating to reinsurance. Certain features of current U.S. tax rules relating to reinsurance transactions among affiliates can create inappropriate incentives to use reinsurance to shift profits out of the United States. My testimony will discuss the use of reinsurance in the marketplace, the particular tax policy concerns raised by reinsurance with foreign affiliates, and the Obama administration's proposal addressing these concerns. Reinsurance is essentially insurance for insurance companies. A reinsurance policy allows an insurer to obtain insurance protection from a reinsurer for all or a portion of the risk it directly insures in exchange for the payment of a premium to the reinsurer. Reinsurance is widely used for a number of business reasons. A direct insurer appropriately can reduce its obligation to maintain capital and reserves to cover losses to the extent that it reinsures a risk. As a result, reinsurance with unrelated reinsurers can allow insurers to write additional business or offer higher limits to policyholders without having to raise more capital, and in addition can protect insurers against catastrophic losses. When used within an affiliated group of companies, reinsurance does not reduce the overall risk for which the group is liable. Nevertheless, reinsurance can be used to transfer premiums and associated risks within the affiliate group in order to efficiently allocate capital for regulatory and other business purposes, such as allowing insurers to lower overall costs by pooling capital from insurance written by various affiliates. Affiliate reinsurance also may be used to lower taxes by, for example, shifting premium income and returns on reserves from higher tax to lower tax jurisdictions. Where all of the parties involved are U.S. taxpayers, the premiums paid for reinsurance will give rise to a deduction for the insurer and corresponding income for the reinsurer, and the group's overall U.S. tax position will remain effectively unchanged. Thus, in the purely domestic context, affiliate reinsurance allows insurers to efficiently allocate capital, generally with no change to their overall federal tax burden. Where the affiliating reinsurer is located outside the United States, however, the tax consequences vary significantly depending on whether the insurance group is owned by a foreign parent corporation, which we'll refer to as a foreign-owned group, or a U.S. parent corporation, which I'll refer to as a U.S.-owned group. In the case of a U.S.-owned group, the income from both premiums and investment returns of a foreign affiliate of the U.S.-owned group generally is subject to current U.S. tax directly or under the anti-deferral rules of Subpart F, without regard to whether the income is distributed. In contrast, in the case of a foreign-owned group, reinsurance of U.S. risk with a foreign affiliate can result in a significant reduction in the overall U.S. taxation with respect to those risks. While a domestic subsidiary of a foreign parent is entitled to a deduction for the reinsurance premiums paid to a foreign affiliate, the income of a foreign affiliate from reinsuring U.S. risks, including the investment income on assets supporting its reserves, is not subject to U.S. income tax unless the foreign affiliate carries on business in the United States. The premiums may be subject to a 1% excise tax unless it's waived by treaty. The ability of a foreign-owned group to reduce or eliminate U.S. income tax on U.S. risks reinsured with its foreign affiliates, including the U.S. tax on associated investment income, creates a significant tax incentive for a foreign-owned group to use affiliate reinsurance to move income from insurance of U.S. risks offshore to low-tax jurisdictions. The Obama administration's fiscal year 2011 budget proposal is designed to address the incentives created by current U.S. tax rules and to level the playing field between U.S.-owned and foreign-owned groups insuring U.S. risks. Under the budget proposal, a U.S. insurance company would be denied a deduction for certain reinsurance premiums paid to an affiliated foreign reinsurance company with respect to U.S. risks insured by the insurance company or its U.S. affiliates, to the extent that the premium income received by the foreign affiliate is not subject to U.S. income tax, and the amount of reinsurance premiums net of ceding commissions paid to foreign reinsurers exceeds 50% of the total direct premiums received by the U.S. insurance company and its U.S. affiliates for a line of business. A foreign affiliate reinsurer that would otherwise be denied a deduction would be permitted to avoid application of the provision by electing to treat its income from the related party insurance that's subject to the disallowance with respect to U.S. risks as effectively connecting income for U.S. tax purposes and thus subject to U.S. tax. The budget proposal would reduce the incentive to use reinsurance to move profits offshore by reducing the U.S. tax benefit for doing so in cases in which a U.S. insurer enters into excessive reinsurance with foreign affiliates not subject to U.S. tax. The administration believes that it is important to level the playing field between U.S.-owned and foreign-owned insurance companies. We have put forward one specific proposal to do so, but remain open to other proposals to achieve this goal. Mr. Chairman, we appreciate the leadership role that you, Senator Menendez, and the Ways and Means and Finance Committees have taken on this subject. We look forward to working with you and other members of the subcommittee as well as the full committee on this important issue. Thank you for the opportunity to testify. I'm happy to take any questions.